Hello and welcome back. So in this video I would like to share with you a big mistake that I did in the last year. My previous video was how good 2023 really went, and it did. The portfolio was performing well, but it could have gone much better if I just had done this little trade. I knew the company very well, but I didn't do anything after even reading all the numbers and seeing that the company was earning a lot of money and it was cheap. And I didn't do anything. And I'll share with you what company that is. I'll share with you what kind of valuation I should have entered the stock at. And then you can use that as education, of course, that if the company is still earning money and the price goes down again, what kind of valuation would I be happy to enter and do a trade at in this stock? So we'll have a look also at what kind of key numbers or key figures I would try and recognize and appreciate in the ticker terminal, for example, which I recommend. And we'll look at the numbers, how I could see that this was a good company, how it was earning money, and how I should have realized that this was a good investment to do. Very nice company, earning money, low debt, high profitability, and a good brand name, lots of customers. And it was really cheap. And the story was that during the year and up until now, you could have bought it in 2022 and also in 2023 for very low prices. And you could have done almost a 3x on your investment and at least double your portfolio or at least the allocation that you had in that stock. Yes, so that let's have a look at the company. So I was talking about this company here, Pandora, the jewelry shop, it's a brand of jewelry stores. And you have Peter Lunch, for example. He recommends you to when you go to shopping centers and try and see what kind of companies that people like there. And when my wife and we went into a shopping center, and she really would be happy to get some jewelry from that shop, and I got her something there. And then it was a really nice store when I went into it, and it was it looked I could see it in different cities. And Pandora is located in the different cities, as you can see here in the ticker terminal. You can read here, for example, what the company is, and they produce their own jewelry and they sell it in their stores. And they have stores worldwide in Denmark, United States, China, UK, and so on. And their headquarters in Denmark, in Copenhagen. And as we can see, there was some opportunity here. It was expensive back in 2021 after the pandemic. In 2020, it was really cheap. You could buy it down at 200 something Danish crowns, and now it's at 1,000. But still, you had an opportunity, and I should have seized that opportunity, and that was to buy it around this levels, and even at 500-600, because you could buy the stock at below 500 and as low as below 400. And today the stock is trading at almost 1,000. So that was a mistake for us who did not invest in it, but there is a good portfolio allocator or manager, Thomas Nilsson, who is on Twitter. You can follow him there. I recommend him. And he shared with the portfolio with us now that he is allocated roughly 10% in Pandora. And I wasn't aware of it back then when I was reading, I think, but we have some ideas in common, and that is to look for companies with high return on capital, on equity, for example. And Pandora has really good returns. And so let's have a look at the numbers together, shall we? So you can see here that the earnings, if you look at the last 12 months earnings, and while we load here, we can I can share with you the long-term debt because it's always nice to have a look at the downside. And in 2020, they had some debt, but it was a far less risky company than if you See here, you only have 1 billion Danish crowns in long-term debt. So that's very little compared to the earnings, and I'll show you the earnings. The net income is one measure of earnings. And you can see the last 12 months earnings. They were you've seen there's a small decline, but it was around 6 billion Danish crowns. Around 2020, it was still profitable, which is impressive, I guess, for a jewelry retailer. And back the last years, we have had last 12-month returns or net income of roughly 4 to 5 billion Danish crowns. And we can see here, if we read the quarterly reports, we can see that it's still earning money. And you might be aware in this particular case, the fourth quarter of the year that's when they earn the most money, probably because of the holidays and December sales. So they have most of their earnings there, but it looked good, 4 billion Danish crowns, and I didn't see any reason to have such a low price in the stock. So we looked at that. We also have a high return on equity, as I mentioned. You saw it in Thomas Nilsson's spreadsheet, and you can see it here in the ticker terminal yourself to go to financial and Sun ratios. If you want to analyze stocks yourself, you can use my affiliate link below in this video here. I recommend it. And you can see that this company has, for example, a long track record of high return on equity. So they're doing something good. I guess they're a well-run shop. They have, I suppose, when they produce their own jewelry, they have the whole value chain, and they have low costs on their goods, and they sell it for example, typical silver products then for a premium price. And they did well. They are still doing well. And then there was an opportunity here. If you measure, you can have a look in ticker and a valuation, and then go to this. You can find this graph by going to the trailing multiples, for example, total enterprise value in relation to EBIT. So that's their operating profit, more or less, in relation to the enterprise value, which is how much you would have to pay to buy the whole company. And you see here, right now, it's trading at a multiple of roughly 14, which is quite normal for a good company. But it was trading below 10 and down at 7, and it was, in hindsight, really cheap. So I should have allocated some portion of my funds to this company, I suppose. Of course, one thing I was missing was this. I have all the companies, as you saw in the last video, that I have some very high quality companies that I think will do. I'm pretty sure that they will do very well in the future. And Pandora, I don't know quite how they will do in 10 years. So of course, that's one of the reasons that I didn't invest there and was holding back. But it was a really cheap company. You could get it below. You would have when you have it at the multiple below 10 here, you're getting more than 10% operating profit compared to buying the whole business outright. So that's including the 1 billion debt they had. So it was really cheap at this level, and if I were to look at this stock again, I would probably want to get shares at this level. So you can, if you find the EBIT, and then I would multiply it by 10, and I'd buy it less than that value as an enterprise value. That's what I wanted to share with you there, the valuation metric here. So clearly it was a cheap stock historically. But on a note there, that if you had looked at a really high quality company like Apple back in 2016, you could have found that company and those shares of Apple at roughly the same enterprise value to EBIT, if I'm not mistaken. I think it was close to 10 there also, because they had so much cash on their balance sheet, for example. So that was really cheap back then, and you could have, I think you could have at least made 6-fold on your investment in Apple back in 2016. Of course, that was when Berkshire Hathaway and Warren Buffett started accumulating. They got shares for more than $30 billion, and they made more than $100 billion on that stock alone. So that's, of course, it's a happy story when you can get really good high quality companies at that multiple. But Pandora is a good company, very profitable, and I did a mistake of not investing at these levels. Yes, so then that was the video, but in the end I will show you what effect you can have on your portfolio if you buy cheap companies and how much you would have to allocate to your portfolio. So let's say we got shares at 400 Danish crowns and now they are worth 1,000. That means that you would have a 250% return or so. And let's say you allocated 20% of your portfolio to this Pandora stock back in 2022 or 23 when they were priced at 400. And let's say the rest of your portfolio returned 0%. And just this one stock, the winner of here, if you had allocated 20% and 80% in the rest, the 80 would still be 80 at the end of the year, but your Pandora share, the value absolutely or nominally, it would be 50 instead of 20, so it would be up 250%, and then the total portfolio would be 130. That means that you would have 30% return on your portfolio, where the rest of your shares were stagnant from the beginning to the end of the year. So that's a way you can invest. You can find one winner, and probably when you hold like a group of high quality businesses, they are very expensive at times, and it might as well be very likely that in 2024 my whole portfolio will be stagnant, and I just have to find one winner that pulls my portfolio up. And for my Norwegian viewers here, of course, we don't want to trigger tax and trade. We want to do, if we want to do well, it's a higher chance of success if you hold the shares for a long time and don't pay tax yet. Like try to avoid it now and pay the tax later if you can. And that's there's a portfolio solution, or in the Nordnet, for example, you can use the ASK. For example, the Scandinavian companies can be traded in that company, that portfolio, and it's deferred taxes there. So you can buy at 400, sell at 1,000, and have a profit tax-free until further. And that's a way that you can get some gains by just allocating 20% of your portfolio, if you can find such a winner as this, and getting more than 2.5x on it. So that was what I wanted to share with you. I did a big mistake here because I knew the company. I should have invested, but I know that I have some favorite companies that I would like to have my cash ready for. So it's not an easy job, this, but I'm happy that the year went well nevertheless. But you can have some great returns if you find some winners here, because the fun thing about the stock market is that it fluctuates a lot. You can find pieces of companies that have shares in the market that trade very low at times, and too low often. It's anomalies, and then you can buy those shares at these quality companies when they are traded at low multiples, like we saw in this video. Enterprise value compared to EBIT is a very sound multiple to use, in my opinion. And yeah, so that was the video. Thank you for watching. See you in the next one.